everyone, welcome back to the channel with Secure. If you're new here, don't forget to hit the subscribe button for more videos on personal finance and investing. Today we're diving into debt mutual funds, what they are, how they work, and why you might want to invest in them. And trust me, it's not as complicated as it sounds. In fact, I'll break it down using an example from our daily lives. So by the end of this video, you'll have a crystal clear understanding. So what exactly are debt mutual funds? In simple terms, debt mutual funds are investment instruments that primarily invest in fixed income securities like government bonds, corporate bonds, treasury bills, and other money market instruments. Unlike equity mutual funds, where you invest in shares of companies and face market volatility, debt mutual funds aim for stability. They don't offer sky-high returns like equities, but are considered safer and offer relatively predictable returns. Here's how it works. When you invest in a debt mutual fund, you're essentially lending money to institutions like companies or the government. In return, they pay you interest. The fund manager pools together money from multiple investors like you, buys different debt securities, and manages the portfolio. Let's simplify this with an example. Imagine your friend asks to borrow rupees 10,000 from you. They promise to pay it back with an interest of rupees 100 after 1 month. So you lend them rupees 10,000 and after 1 month, you get your rupees 10,000 back plus the rupees 100 interest. Now this is essentially how debt mutual funds work. You lend your money to companies or the government and in return, they pay you interest. However, instead of lending to just one friend or company, a debt mutual fund lends to multiple companies and institutions. This spreads the risk, so even if one company defaults, the overall impact is reduced. Now that we understand how debt mutual funds work, let's look at some other benefits and risks. First, the benefits. Debt mutual funds are, number one, lower risk. Compared to equity funds, they are less volatile. Number two, regular income. They offer a steady return through interest payments. Number three, diversification. The fund invests in multiple debt instruments, spreading the risk. But like all investments, debt mutual funds have risks too. Number one, interest rate risk. If interest rates go up, bond prices fall, which could affect your returns. Credit risk. If the companies or institutions fund has lent money to fail to repay, you could face losses. Debt mutual funds are a great option if you're someone who prefers safety over high returns. They're suitable for investors with a low to moderate risk appetite, like those who are looking to park their money for the short to medium term. For instance, if you have funds that you need after a couple of years for a down payment or an emergency fund, debt mutual funds could be a solid choice. There are various types of debt mutual funds based on the kind of securities they invest in and the duration for which they hold these securities. Some of the common types are, number one, liquid funds. Invest in short-term instruments with a maturity of up to 91 days. Perfect for parking money for very short periods. Number two, short-term debt funds. These invest in securities with a maturity period of 1 to 3 years. Number three, gilt funds. These only invest in government securities, which means they carry minimal credit risk but can still be impacted by interest rate changes. So to wrap it up, debt mutual funds are a great way to grow your money slowly but steadily with less risk than equity investments. They can be a good choice if you're looking for consistent returns and a relatively safer investment vehicle. If this video helped you understand debt mutual funds better, give it a thumbs up, share it with your friends, and comment below if you have any questions. And don't forget to subscribe to our channel for more such content. Thank you for watching. I'll see you in the next video. Till then, invest smart and invest safe.